Financial markets were shaken last week as Silicon Valley Bank, or SVB, fell into FDIC receivership. SVB is the first FDIC-insured institution to fail since 2020 and the largest by assets since Washington Mutual failed in 2008. The news, not surprisingly, caused market participants to speculate if there will be another shoe to drop. For some, these developments have brought back painful memories of the financial crisis 15 years ago. That's what we'll discuss in today's Timely Traffic Report. According to our Chief Investment Officer, Jean-Paul Lagarde, Silicon Valley Bank was clearly a consequence of the easy money policy in place during the height of the COVID pandemic. The speculative bubble around venture capital as low interest rates encouraged big risk-taking and the bank's success in attracting these high-quality customers. The risk with banks is that they typically borrow short and lend long, which tends to lead to an inherent funding mismatch, which is why they need to keep a highly liquid amount of reserves. During the height of the pandemic, money was free, businesses were doing well, and expenses were unusually low. This led to strong business profits and higher deposits. Banks were awash with cash. This was basically free money for the banks in the sense that they didn't have to offer an attractive interest rate to garner these deposits, which left the banks free and clear to make money on the money. To do this, banks typically make loans. However, loan demand was low during the pandemic period. So they bought safe, liquid treasuries at very low rates to attempt to earn money off the deposits. Of course, to make any money, they needed to buy longer maturities, 20 and 30-year durations, which exposed them to a substantial amount of interest rate risk. That was all well and good until rates started moving higher. We purposely kept our duration of fixed income portfolios very low because we were concerned about the interest rates and what they would do if they moved higher. SVB didn't do that quite as well. As customers pulled away from their accounts, SVB needed to sell a substantial number of securities that it never intended to, with many of those treasuries having fallen significantly in value. Thus, when they were sold instead of being held, it led to a decrease in the bank's regulatory capital, making it insolvent. What's important to know is we believe SVB's unique customer base and niche market make it far more susceptible to the scenario than most regional banks, and we do not believe that there are any material risks to the banking system as a whole, and in particular the large, systemically important financial institutions. They have very strong capital reserves and liquidity, so the chances that they will be another financial meltdown like 2008 is very unlikely in our opinion. We are currently implementing a cautious strategy with increased cash reserves, short durations on our fixed income allocations, which also means a lower amount of risk than in SVB's case, and zero exposure to any bank bonds. We are keeping a close eye on the current situation and are proactively mitigating risk as more data comes out. If you have any questions, feel free to reach out. And as always, thanks for watching.